Hello friends, this is Sandeep here, and today I'm going to talk about stock market. And in the stock market, I'm going to talk about fundamental analysis. Till now, we haven't seen a lot of things about stock market. I have gone through with mindset of stock market, different kind of things about like profit and loss statement, what actually is balance sheet. A lot of things I have covered. From today onwards, I'm going to start a series on fundamental analysis and which are the main and important ratios and analysis which are actually required for stock market to analyze. Today onwards, I'm going to start. I'm taking picking a ratio on daily basis, and we are going to analyze basis on that ratio if that ratio is useful to compare stocks or not. So today's topic is PE ratio, generally known as price earning ratio. Whenever we talk about P ratio, we come to know that it is a very important tool to the ascertain the valuation of stock. P ratio actually make a relationship between the stock price of the company and and the EPS, that is earning per share. It actually says P ratio actually says what actually the relationship between the price of the company and what is the EPS of the company. Actually, it says that by using the P ratio, we can better way ascertain what is the valuation of the company. We can ascertain P ratio by dividing sales price of a company divided by EPS, that is earning per share. And we can calculate EPS by dividing EBIT, that is earning before interest and tax, divided by number of outstanding share. Once again, I'm telling you how can we calculate P ratio. We can calculate P ratio by dividing share price divided by EPS. Now we need to understand why, how you can we can use P ratio when we valuing any company. We cannot value or cannot determine the value of any company by using P ratio single-handedly until unless we do not focus on the historical value of the company. We cannot judge the P ratio of the company. Therefore, whenever we need to ascertain the P ratio of the company and whenever we need to find out if the P ratio of the company is a good or not, we need to judge. We can judge the P ratio of the company in two ways. First one is take the historical data of the company and compare those historical data with the current value of the company and ascertain the P ratio for the historical data and the current data. By that, you can make a valuation of the company that it is going in the good way or not. Another way is compare the P ratio of the of particular company with a peer company of the same industry of that company, so that you can come to know that what actually the what in where the P ratio of that particular company stands. Now come to the point why we need to use P ratio. When you talk about valuation of the company, it is very important to get to know P ratio. If actually, as per ideal status, P ratio should be less than 20 as per ideal state. If it is on a higher side, more than 20, it means the price of the share is overvalued, and it is generally meant for the growth company which are already has been grown. The price of those company has already been grown in the market. Their future prospect is good, though at the same time the price is on overvalued, and it can come down in later part in the future. Therefore, it is very much risky affair to invest in a company which company P are on a higher side, particularly more than 20. Whereas when the company's P ratio is less than 20, it means the price of the share is undervalued. These companies are mostly are valued stock. Due to some XYZ reason, the price of the share of that company is undervalued, and this can go up in near future. Therefore, we should focus on those companies and invest on those companies. Investing in these companies can be less risky affair, and we can generate moderate to good profit in near future in these companies. To some of these guys, we just need to focus on two important things while we are talking about P ratio. Always think and note down the ideal P ratio should be below 20, and always whenever you are looking at the data of the company in terms of P ratio, take historical data, compare present data with historical data, and compare the company's P ratio with the peer company of the same industry. Thank you, my friends. Thank you very much for listening to me. Thank you very much.